No more cash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, McDonald's just shocked the world with a new announcement. It'll show you what the big fast food chain just said, and more importantly, what it means for their business. And is the Biden administration about to go toe-to-toe with former President Trump? I'll show you what they're claiming and why the Biden administration has no chance of winning this one. Plus, is one of the biggest states in the union about to see its economy completely collapse? I'll show you what's going on and why it means things for the people in this state are going to get far worse. Plus, we have a sponsor for today's show. We'd like to welcome Reliance Global Group to the show. You can find them on the NASDAQ under the symbol RELI. And the reason you do, because if you are a trader, I'm going to show you a chart setup that happened over the last 5 days. That if you'd followed what I'm going to show you, you could have realized about a 40% return. I'm going to show you how the setup is back, and you don't want to miss out on this one. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we find out that McDonald's sales fall in the first since 2020 as traffic drops, indicating that customers are indeed out of cash. And this is not good news, as they just launched recently a $5 meal deal. And this is everything about the economy. And you see it in chains like McDonald's, where consumers who are looking for a quick bite to eat can't even afford the cheapest of meals. And the change comparable sales of Metre tracking restaurants open for over a year fell 1% from the year prior. And keep that in mind, this is at a time when the consumer price index is running around 3%. So their sales dropped 1 against rising inflation, which means a total net drop inflation adjusted of 4%. And that is huge for such a big company. And each of McDonald's geographic segments saw sales declines. In the U.S., the trend was driven by a decline in foot traffic that was partially offset by higher prices, meaning those that did eat there paid more, but it wasn't enough to offset the overall decline in sales. And this is something we expect to see in other companies as we have this now the biggest week of earnings for the quarter, that we're going to find out that U.S. consumers are indeed strapped for cash and possibly completely out. McDonald's sales growth has slowed this year as diners across the world cut back on Big Macs, pinched by years of price increases and tight household budgets. But the real issue isn't about price increases. It's not about budgets. It's about incomes, and that's the part that what we're seeing is people are missing, that incomes are continuing to slide along with hours worked, meaning workers just don't have as much money and can't even afford a value meal. And at the end of the last quarter, the fast food purveyor launched a $5 meal deal in the U.S. to convince diners that it's still an affordable option. And while there's not much detail on how that's going, one of the big problems is it's not good for the actual restaurants. They're not making very much on that, and we're finding out that consumers are balking at higher priced items in a big way. The chain will remain focused on reliable everyday value as diners become more discriminating with their spending because they have less money to spend. Again, no more cash. Other strategic priorities include the chain's chicken lineup and its loyalty program. And one thing that we think consumers are going to be more discriminating with is their trading opportunities. And we have a big one for you with Reliance Global Group. Again, check them out on the NASDAQ on the symbol RELI, because look at this trading setup. You see it trades over the last 5 days between these two zones. The buyers down here, sellers up here. And you see this represents roughly a 10% move. Well, it happened once. It happened a second time. It happened a third time. The fourth time, it didn't quite get all the way there, but now it's set up again, and you're looking at a potential 10% return. Put this on your hot list, because the time to act on Reliance Global Group is right now. Because let's take a look at what the issue is with McDonald's, and as we're going to find out with other companies this quarter, is they're dealing with consumers who cannot keep up with inflation. As we look at the consumer price index shown in blue against total compensation, this is average weekly hours multiplied multiplied by average hourly earnings of production and non-supervisory employees, both shown on a year-over-year rate of change. And what we see is that as workers get less income, you see they're earning less and it decelerated on this red line. What happens is, of course, inflation comes down with a lag. Now, sometimes they go hand in hand. You can see around 1998, of course, wage growth and compensation is slowing. What happens then, of course, the CPI not really going anywhere by the dot-com bubble. Check this out. They're both going down the same time, again around 2003. And we see heading in global financial crisis, that deceleration in total compensation was matched by disinflation. Can you imagine? We got disinflation and then deflation. Here we see again around 2015, and now you see it again. Of course, we're going to hear from the Fed later this week. Of course, they're going to be concerned about rising inflation, but what McDonald's is telling us, inflation is not the issue. Even at $5, they can't get people in the door, and that is a big warning sign for the economy. Now, is, of course, the Biden administration about to go toe-to-toe with former President Trump? Well, Treasury Secretary Janet Yellen is up for bat here as she rebuffs Trump's argument on dollar hurting U.S. manufacturing, and we can say that it is actually does hurt U.S. manufacturing. Janet Yellen, who consistently hews a long-standing Group of Seven commitment to the market-set exchange rates, said in an interview last week that a muscular or strong U.S. dollar needs to be considered in a broader context when assessing its impact. She also played down the role of international trade in undermining American factory jobs. The problem is it does undermine American factory jobs because when the dollar gets stronger, what happens is jobs flow overseas to lower cost manufacturing. And the evidence of that is absolutely clear here. We have the nominal broad U.S. dollar index in blue, except now we're going to look at total compensation of manufacturing employees that are in production and non-supervisory roles by looking at the amount of hours and their weekly wages, and that's shown in red on a year-over-year rate of change. And so what you can see here is a dollar increasing in value, and you can see that has an impact because what means total compensation growth is slowing. As what happens next is jobs move overseas. Employers, of course, don't need as many workers in the manufacturing space and don't need to pay big increases to ones they have. So Yellen here has got that one completely wrong. And she notes that a very strong dollar can discourage exports and contribute to imports. Well, that's exactly how it works. But there's a lot more that's involved, she said. And I think you have to ask, why is the dollar strong? Well, Miss Yellen, that is a fantastic question because as a former Fed chair and now the Treasury Secretary, you should be an expert in the dollar. But let's take a look here. Let's first deal with this export issue as we now look at exports of goods and services in blue against total compensation growth of manufacturing employees in the production and non-supervisory space, both shown on a year-over-year rate of change. And sure enough, you see the evidence. It's very clear. When exports are rising, well, wages and hours worked go up. When they're falling, manufacturers don't need them. Right now, we're seeing that rise because exports are on the increase. But if the dollar has its way, exports are likely to roll over here at some point in the near-term future. And that's going to be the end of what we're going to see for this cycle in manufacturing jobs. As we note, a lot of the regional Fed surveys, in fact, we're going to talk about one of those here in a little bit, are indicating further weakness in the labor market for the manufacturing sector. The Treasury chief went on to say the legislation enacted by President Joe Biden, dubbed Bidenomics, to bolster infrastructure, semiconductors, and clean energy, and through the Inflation Reduction Act, electric vehicles, has offered countervailing support for manufacturing, except it didn't actually work. And that's the problem here. We can look at the goods of durable goods, that is, and we can see this on a year-over-year rate of change as we look at new order growth. And what do we see heading into the recession? Of course, the dot-com bubble, we saw a contraction. We saw that again in the global financial crisis. We saw it happen again as we almost had a global recession around 2015. The pandemic was obvious, but look at the lead into the pandemic. We were headed into a recession then, and now look, it's getting very clear that the policies are not working at all. This is one argument that I don't think the Biden administration can win at all. And we have a very strong economy, she went on to say, as consumer spending and investment spending are robust. Well, it doesn't appear that way. The programs we put in place, the IRA, infrastructure, and all the rest of it, all of that is creating a lot of manufacturing jobs, except it actually isn't. And that's the problem here. We're continuing to hear from manufacturers that new orders are dropping, the backlog of orders are going away, and their demand for labor is falling. But it isn't just a U.S. phenomenon. We're hearing it all over the world, indicating it's not just the U.S. economy that's weak, it's the entire global economy. And U.S. economic strength has, in turn, pulled in foreign capital and elevated the dollar's value, Yellen said. And that is absolutely true. When you have a mismatch in interest rate policy, you're going to see dollars flow to where they can earn the most money. We're seeing that happen right now. And she notes that moves by the Federal Reserve to tamp down inflation have left interest rates higher than other countries, thus supporting the flow of dollars and the demand for dollars, also contributing upward pressure. She says, we believe that's how the system should work. Keyword is believe, but it doesn't always work that way. Here you can see the nominal broad U.S. dollar index against the Fed funds rate. And what do we know? There are periods where the Fed is raising rates and it does cause the dollar to go higher, but it doesn't always work that way, because you can see through 2017 into 2018, the dollar actually went down in value as the Fed then continued to hike, pushing the dollar back up. So there's little evidence that this happens, but we do know that during times of mismatches between our policy here of our central bank and foreign central banks, money does indeed flow into the United States. It does create demand for dollars, and it does, of course, do exactly what she's saying, but it doesn't do it every time. The 2024 Republican presidential nominee also has revived his claim that some of America's biggest trading partners have conspired to keep their currency cheap against the dollar, giving them an unfair advantage. His running mate, Ohio Senator J.D. Vance, has suggested weakening the U.S. currency would give American manufacturers a shot in the arm, and that is somewhat of that is true. Would it give American manufacturers a boost? It would, but it means that, of course, we need to see demand from the rest of the country for American-produced goods. But the notion that the government has any power over the currency that can forcibly weaken it, well, they can't do that at all, and that's one of the risks here. The Fed doesn't have control. The U.S. government doesn't have control, and the notion that you're seeing that other countries are deliberately devaluing their currency, it's not how it works at all. The system relies on demand for currencies in drought when global growth is growing. As we see the global economy slowing and demand for currencies going down, well, it means everybody is going to experience that. In the meantime, the dollar is strong now because of the interest rate differential. When that changes, watch the dollar come down as demand goes down. But another place demand is plummeting is the big state of Texas. If we look at the manufacturing activity, this from the Dallas Fed, saying it remains flat in July amid weakening demand. And I'll show you exactly what causes this as other measures of manufacturing activity weaken this month. Look at this. New orders index dropped 12 points to minus 12.9 in July. That is a massive contraction, signaling a pullback in demand. The capacity utilization and shipments indices also slipped, falling to minus 10 and minus 16.3 respectively. Perceptions of broader business conditions continue to worsen in July as general business activity inched down to minus 17.5, and company outlook index tumbled 12 points to minus 18.4. And we wonder why people can't afford a $5 meal deal at McDonald's. You're seeing it happen in real time right here in Texas. Labor market measures suggested employment increases but shorter work weeks this month, so they're looking to hire people as perhaps they're looking to get rid of some others. The employment index posted a 10-point gain, rising to 7.1, the highest level in 10 months. But look at this, the hours worked index remained negative and fell to minus 13.8 from minus 5. So those who do have jobs are getting less, and expectations. But here's a big one of maybe why they're hiring. Expectations regarding future manufacturing activity mostly pushed up this month, and the question is, do they believe it? Is it hope? I'm going to show you why that is not going to turn out that way, because everything in Texas has to do with one thing. It's called the price of oil. Here we can look at crude oil prices in form of West Texas Intermediate, this out of Cushing, Oklahoma, in red, shown in dollars per barrel against the current new order book for the Texas manufacturing sector. And you can see that where oil prices go, well, that means the Texas manufacturing sector is following. And with oil continuing to weaken in price and showing no sign it's going higher, well, it means demand for manufacturing in Texas is going to continue to fall, and those jobs are likely going to go away along with hours worked continue into decline, which does indicate that if we don't see a rebound in crude oil, that Texas is going to be in a recession sooner than later. And look at some of the comments as customer demand is the overriding concern, decreased credit availability and affordability. This is an issue I've made about on the show repeatedly that happens in a debt-based economy. For the markets we sell into have all but stopped demand. I estimate we're operating at 30 to 40% capacity, suggesting that their customers can't get access to credit. If they can't get access to credit, they can't purchase things. Demand goes down. This is exactly what happens when you invert money curves and yield curves and force the banks to stop lending. How about this? Inquiries and order activity have seemingly halted. The brakes are on. This is pretty common in presidential election years. This comes at a time when things are already volatile due to price pressures and massive inflationary pressures. This is dangerous because at some point, these companies are going to face the ultimate decision is they can't keep employees around if they don't have the revenue to back it. But one place we do feel there's going to be tremendous opportunity, and that is the stock for our sponsor of today's show, Reliance Global Group. You can find them on the NASDAQ under the symbol RELI. Let's take a look at what Reliance Global does, and we'll review those charts and show you a tremendous opportunity. And their growth strategy includes organic expansion of the Reliance exchange agency partner network, as well as acquiring low-risk, high-growth, synergetic businesses. And they're an insurance distribution company leveraging proprietary state-of-the-art technologies to transform and improve efficiencies in the insurance agency brokerage industry. The company delivers insurance products through 3 distinct channels: business to business, mergers and acquisitions, and direct to consumer. They have a highly scalable insurtech platform accelerating the growth of their agency partner network. And what this does is it combines the low barriers of entry of an agency network with state-of-the-art technology. And their goal is to build the Reliance Exchange as the largest agency partner network in the country. And here you can see there's issues agents have to deal with as a barrier for entry as an independent insurance industry are high and getting higher. And this is true. I know many people in this space that are up and coming in the industry. They want to have their own agency, but the bar is indeed set too high. Reliance Global is fixing all of that, which is going to create demand for their products, services, and drive revenue and their stock price. And this will allow existing agents to write more business, get them into the agency model, and gives them, of course, the resources they need to compete with the big players. And what we can see is this was designed to provide instant and competitive insurance quotes from more than 30 insurance carriers nationwide, and that is impressive. And so what this does for consumers, it gets them quotes faster in a more efficient way, gives them more carriers to choose from, it's more convenient, it's fully transparent, and it gives them total peace of mind, creating a win for Reliance Global, their agent network, and consumers. And here you can see some competitive quotes from major carriers, just as a representation of who they can get quotes from. Now let's talk about their business models, because carriers typically pay approximately 15% of premium to the Reliance Exchange, and the exchange retains 20% of the first year commission, and get this, 50% of the renewal commission, providing an ongoing source of revenue for Reliance Global. The exchange also benefits from 100% of carrier overrides, high volume bonuses, and commissions from former agency partners. And they have one way of doing that is driving their online traffic to their agencies and affiliates through 5-Minute Insure. And this is something that we think is going to be huge, creating demand and giving agents access to the agency network in a way that they've never had before. You're going to see more and more agents looking to Reliance Global. And here's what you're going to see as a potential investor. This is a multi-billion-dollar market. It is indeed huge, and it's dominated by some very large players that Reliance Global, it looks to disrupt. They've got a proven management management team, steady organic growth, a scalable model, and a track record of accretive acquisitions, and not to mention that, but a solid balance sheet. And here we can see the report, their second quarter 2024 results, providing a business update, as we are pleased to report consistent and sustained revenue levels for the first 3 and 6 months ended June 30th, 2024, with revenues of $3.2 million and $7.3 million, which represent a 1% and 3% growth from the same periods in the prior year, respectively. And building on the company's strong performance in the first quarter, the second quarter of 2024 continued our trend of sustained organic growth. Throughout the quarter, we continued to emphasize our foundational one-firm strategy, uniting our 9 owned and operated agencies nationwide to function as one cohesive business unit. And this has provided the company with access to higher commission tiers and has created broad cross-selling opportunities, which has and will believe will continue to drive material revenue growth. And the pending acquisition of Spentner Associates, which we believe will be even more impactful than we initially expected, continues to progress smoothly toward an anticipated closing in the second half of 2024. Since first announcing the acquisition plans, Spentner's Ben-managed voluntary benefit insurance segment has experienced impressive growth, now covering over 85,000 employees. This acquisition will be one of the largest in our company's history and will mark a pivotal moment for Reliance, with projections suggesting it will close to double our annual revenues from around $28 million and significantly boost their EBITDA. And so this is an impressive opportunity. Now let's take a look at the stock. Let's go back to the 10-day chart. We didn't look at this, and we'll zoom into that 5-day chart. You see these are supply zones, and this is the bottom one is where buyers are at, the top one is where sellers are at, and right now the stock at the time of filming was sitting at $3.70 right in that lower supply zone. And you can see what happens. Buyers step in here and the stock just shoots higher. That realizes around a 10% gain. You can see it happens repeatedly, oscillating between these two zones. And we're seeing it happen right now in the last 5 days. You can see it traded down into the zone and shot right up into the sell zone. It pulled back and did it again. It pulled down for a third time and took off and broke through that upper zone. It pulled back down for a fourth time. Didn't get all the way up there, but now it's in the zone again, setting up another move higher. This time we think it's going to break up to somewhere around $4.10. That could put a very quick 10% return in your pocket. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.